It begins with a diplomatic shockwave. India announces a comprehensive boycott of U.S. goods, services, and technology partnerships, while simultaneously strengthening trade, investment, and strategic cooperation with China. The news reverberates through financial markets and corporate boardrooms. Investors scramble to understand the implications, and multinational companies reassess operations dependent on Indian markets, supply chains, and talent pools. The first impact is immediate in the trade sector. The United States exports billions of dollars in goods and services to India annually, ranging from technology, defense equipment, and pharmaceuticals, to agricultural products like soybeans, wheat, and cotton. With the boycott, these exports face abrupt termination. U.S. companies reliant on Indian demand experience sudden revenue loss. Agricultural producers, tech firms, and defense contractors are particularly exposed. Stock markets react violently. Wall Street anticipates disrupted revenues, increased geopolitical risk, and broader implications for global supply chains. Indices such as the Dow Jones, S&P 500, and NASDAQ plunge. Technology companies with significant exposure to Indian consumers, talent, and markets are among the hardest hit. Investors flee equities, seeking safe haven assets like gold and U.S. Treasury bonds. Market volatility spikes. Corporate operations face immediate disruption. Technology firms reliant on Indian engineers, software developers, and IT services see productivity decline. Outsourcing arrangements are terminated, software projects are delayed, and operational costs increase as companies scramble to find alternative labor sources. Global IT services firms, cloud providers, and consulting companies face cascading revenue losses. The agriculture sector is profoundly affected. India is a major importer of U.S. soybeans, wheat, and other commodities. Farmers and agricultural corporations face a sudden drop in demand, leading to plummeting prices and rising inventories. Commodity futures markets react with volatility, affecting investor sentiment. Rural economies dependent on exports experience economic strain, layoffs, and reduced income. Defense and aerospace industries are also impacted. India is a major importer of U.S. military equipment, including fighter jets, helicopters, and advanced weaponry. Contracts are canceled or deferred, causing immediate revenue losses for defense contractors. Stock prices of companies with large defense portfolios decline. Job losses and operational adjustments follow as production schedules are altered. Technology and innovation face dual challenges. U.S.-India tech partnerships collapse, disrupting software development, cloud computing projects, and research initiatives. Indian talent previously working in collaborative projects or outsourcing arrangements shifts focus to China-aligned initiatives. Intellectual property flows slow, and U.S. competitiveness in technology sectors faces erosion. The financial sector reacts to heightened geopolitical risk. Banks, investment funds, and multinational corporations with exposure to India reassess risk, increasing credit costs and withdrawing investments. International capital flows shift toward perceived safer markets. U.S. dollar strength experiences temporary volatility as global investors reassess economic stability and risk distribution. Consumer markets face indirect consequences. Technology products, pharmaceuticals, and consumer goods reliant on Indian demand experience lower revenue projections. Companies anticipate decreased sales resulting in cost-cutting, layoffs, and reduced research and development expenditure. Consumer confidence in domestic stock market growth falters. Global trade patterns shift. China emerges as India's dominant partner, facilitating trade, investment, and technology transfer. U.S. influence in Asia declines, affecting multinational corporate strategy, supply chain design, and market access. Export-reliant industries in the U.S. are forced to seek alternative markets, often at higher costs and with lower efficiency. Stock market volatility persists as companies revise earnings forecasts. Indices remain sensitive to trade policy announcements, geopolitical tensions, and market sentiment. Investors reassess exposure to sectors dependent on international trade, technology, and agriculture. Corporate debt ratings may be adjusted to reflect risk from disrupted international revenue streams. Corporate restructuring becomes inevitable. Firms dependent on Indian markets implement diversification strategies, relocate operations, and invest in alternative talent pools. Operational costs rise and timelines for product launches and service delivery extend. Companies unable to adapt face declining market share, reduced profitability, or potential bankruptcy. Small and medium-sized enterprises face acute challenges. Exporters, IT service firms, and specialty product manufacturers dependent on Indian contracts or partnerships encounter abrupt revenue loss. Venture capital investment slows as uncertainty rises. Startups face delays or failure, reducing employment and technological innovation. Energy and commodity markets experience indirect effects. India's pivot toward China influences energy demand, mineral trade, and commodity sourcing. U.S. exporters face lower demand, while global commodity prices fluctuate. Oil, gas, and metal industries experience revenue uncertainty and supply chain recalibration. Stock valuations adjust accordingly. Employment trends shift. Domestic companies attempt to replace lost Indian partnerships with alternative markets or workforce adjustments. Skilled labor shortages in technology and research sectors emerge, creating pressure on wages and productivity. Displacement of international talent leads to operational inefficiencies across multiple sectors. Public sentiment and political pressure intensify. Citizens and policymakers react to economic disruption, lost jobs, and corporate instability. Calls for government intervention increase, focusing on trade policy, fiscal support for affected industries, and strategic economic alliances. Uncertainty persists as policymakers balance domestic interests with global geopolitical dynamics. International relations are tested. U.S. allies observe India's pivot toward China, reconsidering their own trade and security strategies. Multilateral agreements and alliances are reassessed, and global economic influence of the United States is questioned. Diplomatic efforts increase to stabilize relationships and mitigate economic fallout. Healthcare sectors experience secondary disruption. Pharmaceutical and medical technology exports previously reliant on Indian demand face sharp decline. Research collaborations, clinical trials, and medical education programs are interrupted. Hospitals and biotech companies experience delays and increased operational costs. Higher education experiences enrollment and research effects. Indian students, traditionally a major source of tuition revenue for U.S. universities, reduce applications. Research partnerships and collaborative initiatives are curtailed. Universities face revenue shortfalls and potential layoffs of staff dependent on international programs. Corporate investment slows. Mergers, acquisitions, and capital expenditure decisions are delayed due to uncertainty. Venture capital becomes more cautious, particularly in sectors reliant on international collaboration and Indian markets. Startups experience delays, constraining innovation pipelines. Banking and financial institutions recalibrate risk. Exposure to disrupted trade flows, corporate defaults, and international market volatility increases. Lending terms tighten and liquidity concerns emerge. Risk management strategies are overhauled to accommodate geopolitical uncertainty and trade realignment. Stock market indices reflect sectoral imbalances. Technology, defense, agriculture, and pharmaceutical sectors experience significant downward pressure. Investors rotate toward consumer staples, utilities, and domestic-focused industries. Volatility indices remain elevated as markets adjust to uncertainty. Corporate debt pressures increase. Companies with exposure to India face declining revenue, operational inefficiencies, and delayed growth. Defaults and restructurings become more likely. Bond markets adjust yields to reflect higher risk, increasing financing costs for affected firms. Small towns and rural communities dependent on exports experience socioeconomic strain. Agricultural losses, manufacturing disruptions, and service sector contraction reduce income and tax revenue. Local governments struggle to maintain infrastructure and social services. Employment uncertainty contributes to social tension. Global economic influence of the United States diminishes. India-China alignment strengthens alternative trade and technology hubs, challenging U.S. dominance. Multinational corporations redirect investment and supply chains toward India-China partnerships. Strategic influence in Asia and beyond is reduced. Consumer technology products face delayed launches and increased costs. Software, hardware, and consumer electronics reliant on Indian engineering, development, and market access are affected. International competitors capture market share, reducing U.S. global competitiveness. Corporate mergers, acquisitions, and strategic partnerships slow. Companies with exposure to India reassess risk, delaying international collaborations. Venture capital investment decreases in startups dependent on international talent and markets. Industry consolidation occurs as firms attempt to mitigate disruption. Labor markets experience structural adjustments. Workforce retraining programs are accelerated domestically, but skill gaps remain. Automation initiatives are implemented to compensate for lost talent and partnerships, requiring significant capital investment. Long-term productivity and innovation pipelines are altered. Social inequality is exacerbated. Job losses in export and technology sectors disproportionately affect middle and lower-income workers. Wealth concentration persists among firms and sectors less reliant on international markets. Social unrest and political pressure rise as economic stress becomes visible. Transportation and logistics networks adjust. Shipping routes, trade corridors, and supply chains are realigned toward China and alternative markets. Increased costs and operational delays impact U.S. manufacturing and consumer goods sectors. Energy and freight companies face revenue volatility. Healthcare access and pharmaceutical production are indirectly impacted. Reduced exports and disrupted collaborations slow product availability. Hospitals and research institutions face delays in drug trials, medical device development, and clinical studies. Global supply of critical medical resources is affected. Education and innovation capacity are diminished. Indian students' absence reduces university revenue and research capacity. Collaborative initiatives in technology, biotech, and AI slow down. Long-term workforce readiness and intellectual capital generation are constrained. Financial markets experience persistent volatility. Indices reflect ongoing uncertainty across technology, agriculture, defense, and pharmaceuticals. Investor sentiment is influenced by corporate earnings revisions, trade news, and geopolitical developments. Liquidity shifts toward safer domestic sectors. Corporate strategy pivots toward resilience. Firms diversify markets, implement automation, and invest in domestic workforce development. Operational costs increase, efficiency declines, and growth projections are revised. Companies unable to adapt face reduced market share or insolvency. Global trade realigns. U.S.-India trade is replaced by India-China cooperation, altering global supply chains. U.S. influence in Asia diminishes, while China gains strategic and economic leverage. Multinational corporations adjust operations to align with new market realities. Stock market recovery is prolonged. Investor confidence depends on corporate adaptation, new trade agreements, and geopolitical stability. Technology-heavy indices, previously growth engines, adjust to slower innovation and revenue disruption. Long-term market growth is recalibrated. Ultimately, India boycotting the U.S. and deepening ties with China creates cascading economic, corporate, and geopolitical consequences. Trade disruptions, stock market volatility, slowed innovation, and reduced global influence characterize the new reality. Recovery requires strategic policy, corporate adaptability, and geopolitical negotiation to restore market stability. The scenario highlights the delicate balance of global trade, diplomatic relationships, and economic interdependence. It underscores how shifts in international alliances can reshape the U.S. economy, corporate strategy, and financial markets for decades.